Welcome back to Alpha Recap, your quick, no-nonsense wrap of today's market movers. I'm Marcus, and with me is Josh. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks, Marcus. Great to be here. Lots to unpack from a pretty volatile session.
So, what really stands out here is the trifecta we saw. A credit warning tied to AI spending, a massive blue-chip wobble, and an absolute retail microcap frenzy. Let's start with the big picture credit note.
Right. Moody's put out a note saying unprecedented AI spending is starting to show up in credit profiles for the largest tech firms. Think Amazon, Alphabet, and Meta. The agency flagged rising leverage, off-balance sheet financing, and huge capital commitments that could compress free cash flow.
I mean, when you step back and look at this, it's not just a growth story anymore. It's a financing story. Can you explain why that matters to people who normally think of tech as a growth trade?
Sure. Imagine you need to build lots of data centers and buy expensive chips. You can fund that with cash, you can sell equity, or you can borrow. Moody's is worried these firms are taking on more debt or creative financing to pay for that build-out. That increases leverage and could raise borrowing cost or pressure credit ratings if cash flow doesn't keep up.
So, investors watching credit desks and bond markets should care because funding costs ripple back into equity behavior?
Exactly. If rating agencies start to push on leverage, the cost of corporate debt can rise. That means buybacks slow, dividends get reconsidered, and volatility can increase as desks reprice risk across large caps. It's a plumbing level story, not just headlines about AI features.
Right. And the other thing is, analysts noted those same CapEx drivers can buoy revenue long-term, but create short-term margin and cash flow stress. So it's a two-sided coin.
Follow-up items to watch are any comments from Moody's, whether those big tech firms disclose updated CapEx pacing, and any near-term debt offerings that could reveal how they're financing projects.
Quick reaction. Wow, big implications.
Unnerving for credit desks.
Moving on. The other headline was a big hit in a major cap. Tesla logged one of the session's largest single-day drops. It finished the day down about 14.5% to roughly $320 on very heavy volume, about 114 million shares.
Yeah, that tracks. A move like that in a major cap does a lot of mechanical things to the market. Options prices spike, implied volatility jumps, and algorithms that trade momentum or gamma tend to reweight positions.
So, what happens after a shock like that? Is it just more noise, or does it genuinely change the risk backdrop?
Both. In the immediate term, it raises short-term volatility and forces reassessment of concentrated long positions and margin assumptions. In medium term, it can pull other correlated growth names around it because market-making systems and dealers widen spreads or step back. That amplifies moves in smaller correlated baskets.
Honestly, I was a bit surprised by this one.
Same. And keep an eye on early session volume and option implied volatility when markets reopen. Those will tell you whether the repricing continues or if it was a one-day event.
Now, let's jump into the microcap and retail mania, which was wild today.
Totally. Several small listings exploded on heavy retail flows and headlines. One small payments-related company jumped about 48% after reports of a Coinbase payments integration, trading well into the tens of millions of shares. Another speculative listing spiked roughly 600% on similarly high volume. Dozens of other penny and warrant listings posted triple-digit moves.
And that pattern, big percentage moves on low floats, creates a very different risk set than the big cap moves.
Right. For many of these names, a relatively modest dollar flow can produce outsized percentage swings because floats are tiny and bid-ask depth is thin. That means slippage and execution risk are huge for anyone trying to trade beyond a small retail size.
Volume tells the tale.
Exactly. And some of these names cited corporate actions like reverse splits, which can concentrate ownership and exacerbate illiquidity after the split. So the moves are often momentum-driven rather than reflecting material fundamental changes.
Right. So traders should check if the catalysts, like partnership confirmations or filings, actually show up.
Yes. What validates a rally is follow-through volume and confirmation of the reported catalyst. Absent that, these can reverse hard once retail attention shifts.
Short reactions. Unnerving and exciting for day traders.
High risk, high dispersion.
Now, a quick note on legal and event risk. A securities fraud investigation notice hit a steady industrial name today, adding headline risk. That kind of notice tends to compress the multiple and increase volatility until there's clarity.
Right. Litigation headlines can be catalytic. Investors often sit on the sidelines until filings, settlements, or company statements provide color. In the meantime, pricing can get disorderly, especially if liquidity is already weak.
The tape also showed steep one-day collapses in several thinly traded listings. Some went down 30 to 60% or worse, which highlights how quickly price discovery breaks down in low liquidity names.
Correct. A handful of listings essentially traded to zero or collapsed on negligible volume. That's the downside of tiny markets. A single block trade or reporting quirk can wipe out liquidity and crater prices.
So, pulling these threads together, what are the emerging patterns here?
We saw three linked themes. First, a credit focus creeping into equity narratives. Moody's makes AI a financing story, not just a tech race. Second, a major cap shock, the large one-day drop that raises system-wide volatility. Third, retail and social flows chasing outsized returns into microcaps, which creates extreme dispersion between liquid large caps and illiquid small listings.
That connection is key. Credit headlines can lift volatility in big caps, which in turn pushes attention and flows into tiny names where the potential payoff is bigger. And so is the risk.
Exactly. And that increases the probability of noisy follow-through when the market reopens, either continuation or sharp reversals, depending on early session volume and any confirming news.
So, what should listeners watch when markets reopen on Monday?
Key items. Follow through in the big shock. Check early direction, volume, and option volatility on the major cap that fell. Watch for Moody's follow-ups or any commentary from the largest tech firms on CapEx or financing plans. Look for catalyst confirmations on the microcap names that rallied, partnership announcements, or SEC filings. And monitor any legal filings on the industrial name with the securities notice.
Right, and persistent volume is the validation. If those microcaps keep trading big volume, momentum may have legs. If volume collapses, those moves could reverse violently.
One more practical point. When markets have elevated cross-market volatility, execution and slippage matter more. Different investor cohorts face different risks. Institutional desks worry about widened spreads in big caps, and retail faces execution risk in tiny listings.
To wrap this up, Josh, give us 3 clear takeaways for listeners.
First, Moody's framing of AI as a credit story matters. It can affect borrowing costs, buybacks, and overall risk premia. Second, a big cap shock today increased short-term volatility and can mechanically amplify moves across correlated names. Third, the microcap rally was largely momentum-driven. Confirm catalysts in watch volume, because liquidity asymmetry can make these moves dangerous.
That's a useful checklist. Quick reminder, this discussion is informational only. We're not offering personalized investment advice, and analysts note data suggests elevated volatility and event risk.
Right. Analysts note momentum indicates higher near-term volatility, but that's different from a recommendation.
All right, thanks, Josh. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. See you next time.